Last week, investors were starting to wonder if Santa Claus had left town a little bit early. It's been concerning. We haven't seen a strong market in December. And last week after Christmas, the S&P 500 had 2 negative days on Thursday and Friday. What was particularly concerning on Friday was that the growth sectors, the consumer discretionary and technology sector that have been leading the market recently, did not perform that well. And investors are wondering, is that a sign of things to come coming up shortly? And it's a little bit concerning given that December has not been a strong month for the stock market. And I think it's a little bit of profit taking place at this point. It has been a tough slog. We've seen interest rates rising. The yield on the 10-year Treasury note last week closed at 4.6%, up for the week. Now, if we go back, the 10-year yield has risen 1% since its bottom on September the 16th. At the same time, the Federal Reserve started to cut on September the 18th, so 2 days after the bottom, and they've cut 1%. So the Federal Reserve has cut 1%, and the 10-year yield has gone up by 1%. Investors are really wondering and saying, well, what's going on? Why is that happening? I think there's 3 reasons why we've seen this phenomenon taking place with the yield on the 10-year increasing by 1% at the same time the Federal Reserve is cut by 1%. The first reason I think is inflation's still there. It's been showing a little bit of stickiness and perhaps there's concern that it could be going up in the future. Also, the economy is still ticking along here okay. And that from that perspective, bond investors are saying, well, we want higher interest rates in that type of environment. A third reason that not many people are talking about yet, and that is that there's a lot of bond issuance that comes due, a lot of government bonds next year in 2025 that come due. And the Fed's going to have to roll those over, and that could be a little bit of a problem. And investors are worried about that, and that could be pushing up interest rates. Yellen basically started to really finance the liabilities of the US government at the short end of the curve. Typically, the Federal Reserve, Treasury I should say, issues bonds approximately 15% of their portfolio at 2 years and under. Yellen, what she did was took that to over 30%, which is just absolutely insane. And a lot of investors are saying, why didn't Yellen take advantage of the low rates at the long end of the curve? Well, the reason was that at the front end of the curve, it acts more like liquidity in the markets, and it helps to push the markets higher and provide liquidity into the economy. And now, this is a huge problem as Trump comes in. And so next year in 2025 alone, we see the government having to finance $7.6 trillion, an absolutely huge amount. Bond investors are worried about that. They're saying that has to be rolled over at higher interest rates. That could be a huge, huge problem. So that's one of the reasons why we're seeing interest rates increasing as well at this time. And bond investors simply, I think, don't believe the Federal Reserve should be cutting as much as they are as well. That's another factor. So rising interest rates in this environment has been actually really weighing on the bond market, obviously, and the stock market as well. Oh, by the way, if you're wondering where I am going through all these Christmas lights here, I'm actually at the Coronation Park in Oakville. They have a Christmas light display every year from mid-December into early January. I thought I'd come down here this evening and film the video here on a beautiful, beautiful walk. It's absolutely gorgeous. Pleasant evening. It's nice and mild out. I'm able to wear one of the sweaters that my wife has made me in the past, hand knitted. I'm cheating a little bit here. I'm wearing some shirts, extra shirts underneath, but I don't need a hat. Absolutely gorgeous evening, no wind, and I thought I'd enjoy it in the park tonight, shooting this quick video. So we've seen rising interest rates, which has really been tough on the markets, and a rising US dollar. When those two factors occur, And the US dollar is going up partly because of rising interest rates. We're seeing interest rates being cut around the world, but the US is perhaps not moving as fast, and that's helping to prop up the dollar. Now, a lot of investors are going to look back and go, oh, back in 2016, when Trump was elected, we saw the US dollar go up. We saw the interest rates go up as well in November into December very strongly, just like what we see now. And then we saw in December, we saw them start to turn lower into the next year. A lot of investors are hoping for that scenario again. I'm not so sure that's going to happen this year. Might take a little bit longer. We're really not sure how it's going to play out with Trump getting into power on January 20th, what the narrative is going to be. Is he going to start with tax cuts or layoffs? I think he's going to start with things like government freezing. And that's actually government hires being frozen. That's actually a huge concern for me next year is the labor numbers. If we take a look at the labor numbers, we've seen a lot of weakness in a lot of these numbers. Hasn't really shown up in the unemployment rate or the non-farm payroll numbers. But if we take a look at private employment from November 2023 to 2024, it actually went down over 800,000 people. That's huge. Now we're seeing government employment go up. And it's not just at the federal level. In fact, it's mainly at the state level and municipal level. You may ask, well, why is that? They were given so much money during COVID. Just incredible. I mean, this whole thing was absolutely insane. And they went out and basically spent it all and hired a ton of people, way more than they should have. That money's dying out now. And if government employment gets frozen at the federal level and we see funds start being frozen, going to the state and municipalities as well, that could become problematic. And we might actually start to see the labor numbers worsen. I know Powell in his last press conference said, well, he expected unemployment to go from 4.2% in 2024 to 4.3% at the end of 2025. I'm sorry, I think he's way off on that. I think he's going to be very low. But that's a big factor to watch out for next year for sure. So what should we expect from the market coming up shortly?
I just want to mention that on Friday, December the 27th, I was on BNN Bloomberg with Paul Bagnall for The Street discussing credit spreads and how credit spreads are really low at this time, which indicates that bond investors don't see a lot of risk at this time, which often transfers over to the stock market as well, indicating that in the short term, the stock market is on stable footing. I'll add this clip from BNN to this video down below.
Well, on a seasonal basis, we tend to find that the S&P 500 does quite well in the last few days of December into January. January tends to be positive. This year, we might see investors lower their expectations coming into the inauguration for Trump. That's just such a wild card to see what happens because there's so many unknowns about what's going to take place, what's going to be issued on January the 20th and how that's going to be perceived in the marketplace. So we may see some tempering of expectations in early January as investors start to wonder if Trump's policies he wants to introduce. There's some kids here enjoying the park. So investors may be looking for how the market's going to react to when Trump takes power on January the 20th. And that's a wild card because there could be a lot of policies that he could start right away. And investors may say, well, that's really positive, but there's going to be a lot of investors starting to say, well, this may be harder than we expect to get done. It's hard to say which way that narrative is going to go. So we may see some muted performance for the S&P 500, but we do see some positive seasonal tendencies for the market at this time. It's going to be an interesting weekend. Well, it's going to be an interesting few weeks leading up to the inauguration. Thank you very much for joining me today.